Hi everyone. Welcome back to our video series on small business finance. Today, we're diving into some of the most crucial tax topics for small business owners. We'll cover everything from understanding your business's tax obligations to maximizing deductions and credits, and finally, how to stay compliant with the IRS by making quarterly tax payments. By the end of this video, you'll have a solid understanding of how to manage your business taxes and save as much as possible while avoiding penalties. Whether you're a seasoned entrepreneur or just getting started, this lesson will be a game changer for your tax strategy. Let's jump right in. Lesson 1, Business Taxes 101. Let's start by getting clear on the taxes you owe at the federal, state, and local levels. As a business owner, staying compliant with tax obligations is non-negotiable, and understanding how each level works will help you avoid penalties and fines. At the federal level, we have the most common taxes like income tax, self-employment tax, and payroll taxes. Every business must pay federal income tax on their profits. And if you're self-employed, you also pay self-employment tax. Example, take a freelance web developer who makes $100,000 in a year. They'll need to pay federal income tax on their profit, plus a self-employment tax, which covers Social Security and Medicare. If you have employees, you're also responsible for employment taxes, which include withholding Social Security and Medicare taxes from your employees' wages and paying your portion as an employer. Example, let's say you own a small bakery with 3 employees. You'll need to withhold 6.2% for Social Security and 1.45% for Medicare from each employee's paycheck, and then match those contributions on your end. Next, we have state taxes, which vary depending on where your business operates. Most states impose income taxes on businesses, but some states, like Florida and Texas, don't. Example, if you run a retail store in California, the state imposes a corporate income tax of 8.84%, which means your state tax bill could be substantial depending on your profits. Some states also charge franchise taxes, which are a little different. A franchise tax is essentially a fee for the privilege of doing business in the state. It's based on factors like income, capital, or assets, depending on the state's tax code. Example, a business in Delaware, even if it's an online-only business, needs to pay Delaware's franchise tax, which is calculated based on the number of shares the company has authorized. Finally, we can't overlook local taxes. Depending on your city or county, you might be responsible for things like business property tax, local income taxes, or specific licensing fees. These taxes are often tied to where your business operates or where your employees live. Example, a coffee shop located in New York City not only has to deal with state income tax, but also faces local taxes based on the profits of the business. The same business might also need to pay property taxes on the building if they own it. What's crucial to remember is that you need to comply with all 3 levels of tax: federal, state, and local. Missing one could lead to costly penalties, so be sure to stay on top of all your obligations. Now let's talk about some specific taxes that businesses encounter regularly: sales tax, payroll tax, and income tax. Sales tax is a tax on goods and services that businesses must collect on behalf of the state and sometimes local jurisdictions. The rates and rules vary, but if you're selling products or certain services, you're responsible for collecting and remitting these taxes. Example, if you own an e-commerce store and sell a product to a customer in Arizona, you'll need to collect 8.6% sales tax. If that product costs $100, you'll charge $108.60 and later remit that $8.60 to the state. It's important to track nexus, which determines where your business has a tax obligation. Nexus can be established through a physical presence, like a storefront, but increasingly, states are enforcing nexus laws based on the number of sales or revenue generated from out-of-state customers. Example, an online retailer selling products nationwide might have nexus in a state if they make more than $100,000 in sales or 200 transactions in that state, which requires them to collect sales tax even if they don't have a physical presence there. Payroll tax is critical for employers with staff. You must withhold Social Security and Medicare taxes from employee wages, and you also contribute to these taxes yourself. Payroll taxes include federal unemployment taxes, FUTA, and state unemployment insurance, SUI payments. Example: a small tech company with 5 employees needs to withhold 7.65% of employee wages for Social Security and Medicare, while also contributing 7.65% as the employer. In addition, the company must pay FUTA and SUI taxes on each employee's wages. Finally, let's talk about income tax. If you're a C corporation, you pay corporate income tax on your profits at the federal level, which is currently set at 21%. If you're a pass-through entity, like an LLC or S corporation, your business's income passes through to your personal tax return, meaning you'll pay income tax based on your personal tax rate. Example: a C corporation with $500,000 in taxable income will owe $105,000 in federal corporate income tax at the 21% rate. A sole proprietor with the same income would report it on their personal tax return and pay based on their individual tax rate, plus self-employment tax. Understanding how these taxes interact with your business will help you manage cash flow and stay compliant. Lesson 2: Tax Deductions and Credits. Now, let's talk about how you can lower your taxable income through tax deductions. Deductions allow you to subtract certain expenses from your income, which reduces the amount of tax you owe. Here are some of the most common deductions for small businesses. One of the most valuable deductions is the home office deduction. If you use a portion of your home exclusively for business purposes, you can deduct a percentage of your home-related expenses, like rent, mortgage interest, utilities, and repairs. Example: a freelance writer who uses a 150-square-foot room as a dedicated office space can claim $750 using the simplified method, which allows a $5 deduction per square foot. Another important deduction is vehicle expenses. If you use your car for business purposes, you can either deduct the actual costs of maintaining the vehicle or use the standard mileage rate set by the IRS. Example: a real estate agent driving 15,000 business miles in a year can claim $9,900 in deductions using the IRS mileage rate of 66 cents per mile. You can also deduct business meals, but be aware that only 50% of the cost is deductible if the meal is business-related. Example: a marketing consultant spends $500 taking a client out to lunch to discuss a new project. They can deduct $250 of that expense. Additionally, small business owners can deduct startup costs related to launching their business, up to $5,000 in the first year, with the remaining costs amortized over time. Example: an entrepreneur spends $3,000 on market research and $2,500 on legal fees when starting their new business. They can claim the full $5,000 in the first year. These deductions help lower your taxable income, meaning less money out of your pocket when tax season rolls around. In addition to deductions, tax credits can directly reduce your tax bill. Let's look at some of the most powerful tax credits available to small businesses. The Research and Development (R&D) credit is one of the most beneficial. If your business spends money on developing new products, processes, or technologies, you may qualify for this credit. Example: a biotech startup spends $100,000 on R&D to create a new medical device. They can claim a $10,000 tax credit, reducing their overall tax liability. Next, we have the Work Opportunity Tax Credit, WOTC, which incentivizes businesses to hire from specific groups, such as veterans or long-term unemployed individuals. Example: a restaurant hires a veteran and qualifies for a $4,000 tax credit through the WOTC program. The Small Business Healthcare Tax Credit can help if you offer health insurance to your employees. Businesses with fewer than 25 full-time employees can claim a credit of up to 50% of the premiums paid. Example: a boutique law firm with 10 employees pays $20,000 in health insurance premiums and qualifies for a $10,000 credit. Tax credits like these provide direct reductions in the amount of taxes owed, and they can make a huge impact on your overall tax strategy. If you're self-employed or run a business without taxes being withheld from your paycheck, you need to make quarterly estimated tax payments. These payments help cover your federal income taxes and self-employment taxes throughout the year. The IRS requires quarterly payments if you expect to owe more than $1,000 in federal taxes. The deadlines are April 15th, June 15th, September 15th, and January 15th of the following year. Example, a graphic designer who earns $80,000 annually and expects to owe $12,000 in federal taxes must pay $3,000 each quarter to avoid penalties. To calculate your estimated payments, you can use IRS Form 1040-ES for individuals or Form 1120-W for corporations. You'll estimate your annual income, subtract any deductions, and apply credits to arrive at your taxable income. Then, divide by 4 to determine your quarterly payments. For self-employed individuals, don't forget about the self-employment tax, which covers Social Security and Medicare. It's 15.3% of your net income, and you'll need to account for that in your quarterly payments. Example, a consultant earning $50,000 in net income will owe $7,650 in self-employment taxes. They can deduct half of that from their income when calculating their quarterly payments. Making these payments on time is essential to avoid penalties, and you can pay online through IRS Direct Pay or the Electronic Federal Tax Payment System, EFTPS. Let's talk about compliance. The IRS expects businesses to meet quarterly payment deadlines, and missing a payment can result in penalties. To avoid penalties, follow the Safe Harbor rule. This rule protects you from penalties if you pay 90% of your current year's tax liability or 100% of the tax you owed last year, 110% if your adjusted gross income is over $150,000. Example, a freelance photographer who owed $8,000 last year can avoid penalties by paying $8,000 in estimated taxes this year, even if they expect to owe more. To stay organized, use accounting software like QuickBooks or Xero to track your income, expenses, and tax payments. This will ensure you don't miss a deadline and helps keep all your records in one place, especially when you need them for your annual tax filings or if the IRS audits your business. To wrap up, we've covered a lot of ground today, from understanding federal, state, and local tax obligations to maximizing deductions and credits and ensuring you stay compliant with quarterly tax payments. These are essential strategies to help you manage your business's finances effectively and avoid any surprises come tax season. Remember, planning ahead and staying organized with your tax obligations will save you time, money, and stress in the long run. Thanks for joining me, and I'll see you in the next video where we'll continue helping you build a financially healthy business.